course, that you nailed it again on this setup, is this earnings season has been winding down, and that's really where we want to start because a lot of these companies did report better than expected.
Right. I mean, the beat rates were above average, the expectation versus expectations, and not only that, the guidance was better than many people thought it would be. So better than feared quarter. The growth rate was negative, but not by as negative a margin as people thought at the beginning of earnings season, and we'll see what happens in the second quarter.
You know, one of the things which is interesting is that there are 10 stocks which really account for 90% of the rally this year, and sometimes people forget that.
Right. When you think about Microsoft, Google, Amazon, Meta, and NVIDIA, what they all share in common is exposure to AI, and artificial intelligence is all the rage these days. Many think that's going to add to the growth rates for those companies. And in addition, many of them took some major cost-cutting measures in the last couple of quarters that helped boost their results. So those names have carried the S&P 500. They've certainly carried the NASDAQ. And despite all the negative news we've heard, the S&P is up 8% for the year.
And that certainly caught a lot of people flat-footed. I mean, there's so much bearish sentiment out there right now. So you can see when the tech rally continue, that certainly caused some people to reevaluate what they own. But seasonality is a real thing. And here we go, just wrapping up May. And the old saying of sell in May and go away might be a reality.
Right. And over the long haul, on average, that has been a better 6-month period to avoid than the 6 months that are started by October through April. But generally speaking, you know, we've got a lot of issues out there. We've got the debt ceiling debate. We've got questions about the banking system. The regional bank index continued to go down this week, despite the fact that many people were trying to call a bottom. So there are a lot of significant headwinds for the market, not to mention the fact that T-bill rates continue to be above 5%.
And you talk about, you know, where there's opportunity in the market, and we certainly talked about the potential bank crisis, and that maybe we haven't seen the end of the bank crisis because of the amount of commercial real estate that's out there. But some people are talking about a tactical opportunity there.
Right. I mean, one of the things about financials, and this is a study that Ned Davis researched, is what they found is after the last Fed rate hike, as the yield curve begins to steepen, the financials in general have outperformed the subsequent 6 months. So from these low levels, it wouldn't shock me at all if that were the case. The other thing that came out this week, and I thought this was really interesting, both Stanley Druckenmiller and Warren Buffett talked about taking advantage of other people's mistakes. What Buffett said, and I paraphrase a little bit, is we wait for the fat pit, holding lots of cash, when those who did stupid things are found to be swimming naked. And what Druckenmiller said was, when you have free money, people do stupid things. When you have free money for 11 years, people do really stupid things. Obviously, the regional banks recently, we've had Bed Bath & Beyond, but he assumes there are more bodies coming. Just make sure to preserve your capital until they present themselves. And that's essentially the way we've been approaching the market.
And how you do that, folks, is not really trying to time all the way in and time all the way out, but making sure that you have dry powder in your portfolio. And that can be as easy as increasing your fixed income position or holding some cash that certainly pays a much better interest rate than we've seen in almost a decade.
Yeah, one of the things we did, we've liked the energy sector for a long time, and the energy sector has been under selling pressure over the last couple of months as people fear the onset of a recession. But some of those energy companies that generate great free cash flow and pay a dividend over 4% are now at much more attractive buy levels. So we add a little bit of exposure there in one of our strategies.
And then lastly, there's been a lot of talk about the debt ceiling debate, and we're going to hear more about that. And of course, we do believe that the banking crisis still is in front of us. But as you said, as that yield curve begins to flatten out, that could be something that we're going to look at as we go into the rest of the year.
Well, and by that you mean you're talking about short-term rates starting to come in, because right now there's a little bit of concern. So the 1-month T-bill is actually trading at 5.5%, which is significantly higher than it would if it weren't for this situation. The other thing, and people need to remember this, in 2011 we had the same sort of situation, and it was after they approved the debt ceiling that the market sold off, because that involves taking liquidity out of the system in the short run.
And I just want to say we're going to talk about that in just a minute with Brian Jacobson, but make sure that the facts and circumstances are the same. Most importantly, folks, know what you own, why you own it, and how much you're paying for it.